This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, and welcome back to my channel. It has been 6 months since the Hamilton DayMax series officially launched on July 15, 2025. Back in 2025, I mentioned that this might be the most sincere product release of the year. Now that half a year has passed, I want to look at how the DayMax series has actually performed. In this video, we are going to do a deep dive into the data and the strategy behind these ETFs. Before we get into the details, let's address the performance. To keep things fair, I have selected the window from July 15, 2025, which was the launch day, to January 16, 2026. This gives us exactly 6 months of data. First, let's look at CDAY. On July 15, 2025, its closing price was $23.88, and by January 16, 2026, the price hit $26.29. That is a price growth of 10.09% alone. During this period, it paid out $2.18 in distribution. Since the data on Seek Alpha does not yet cover a full year, I had to calculate the total return manually. The total value, which is $26.29 plus $2.18, equals $28.47. That is a total return of 19.22%. This outperformed the CMVP index return of 15.79% and even beat the 25% leveraged version, CWIN, which returned 18.98%. Using the same method for SDAY, the price went from $23.79 to $24.56, which is a 3.24% growth in share price. With $2.17 in distribution, the total return is $26.73. Dividing that by the starting price gives us a total return of approximately 12.36%. This also outperformed both the SMVP index and its leveraged version SWIN. Finally, we look at QDAY. Its starting price was $24.29, and it closed at $25.96 on January 16th. That is a 6.88% growth in price. With $2.42 in distribution, the total return is $28.38, representing a 6-month return of 16.83%. This managed to beat BMO's ZXLK, which tracks the same index and returned 14.36% in the same period. It is worth noting that these calculations do not include dividend reinvestment. If you were to reinvest the distribution, the results would be even more impressive. Now that we have covered the performance of CDAY, SDAY, and QDAY, I want to share some deeper personal insights. Let's look at the underlying logic of CDAY and SDAY. These two funds hold Canadian and US companies that have increased their dividends for many consecutive years. These companies, without exception, possess deep moats. While their growth might not always be the highest in the market, their defensive attributes are excellent. To have better insight for CDAY and SDAY, we need to look at the data of CMVP and SMVP, which are the underlying ETFs of CDAY and SDAY. Looking at the hard data, the volatility of the index tracked by CMVP is 15.98%, while the volatility for SDAY is 17.69%. If we look at the maximum drawdown over the past 360 days, CMVP was at negative 8.81%, while SMVP was at negative 11.4%. These two underlying assets provide a very stable foundation for the entire portfolio. On top of this steady base, these ETFs cleverly use 1.25 times leverage. The specific strategy is that for the extra 25% exposure in VOO, they sell at-the-money call options that expire on the same day. This is the zero DT strategy we often talk about. Through this high-frequency, high-intensity operation, they have achieved an annualized dividend yield of 18%. While the leveraged VOO exposure does increase the drawdown, the core of the fund is still composed of defensive blue-chip stocks. This creates a fascinating combination of a sturdy shield and a sharp spear. In contrast, QDAY has a completely different characteristics. The underlying asset for QDAY is XLK, the Tech Select Sector Index. This means QDAY lacks the defensive dividend growth foundation found in CDAY and SDAY. It is a pure offensive player that has essentially abandoned defense. Because XLK is naturally volatile, combined with the leverage and the zero DT strategy, QDAY has incredible explosive power in a bull market, but it has no shield to rely on during a pullback. As investors, we also need to pay attention to the costs. The management fee for these three ETFs is 0.85%, which is honestly not cheap in today's market. Because the underlying assets are often Hamilton's own ETFs, which also have their own fees, there is a clear phenomenon of double charging or fee layering. This will, to some extent, increase our holding costs. However, judging by the performance, Hamilton's higher fee seems justified. The design of these ETFs, the selection of targets, and the covered call strategy have all proven to be very well engineered so far. Looking at Hamilton's broader product strategy, you can see a very systematic logic where new products support the old ones. For example, when they launched their YieldMax series, they swapped the holdings in HYLD and HDIV to their own new funds. When SMVP and CMVP were first released, they might not have attracted much investment, but Hamilton used them as the base to launch SDAY and CDAY, and then added SDAY and CDAY into the portfolios of HYLD and HDIV. They recently launched QMVP and UMVP, and I'd bet anything that they'll soon swap QDAY's XLK holding for their own QMVP. Why let another company take the management fee when you can keep it in-house? This classic Hamilton. Also, I believe the current structure of SDAY and CDAY is the result of deep deliberation. From a pure efficiency standpoint, SDAY could have been designed as 125% VOO, and CDAY could have been 100% XIU plus 25% VOO. While that might have performed even better, it would have conflicted with the positioning of their own HYLD and HDIV funds. In terms of product management, Hamilton appears much more thoughtful and clever than other fund companies. I don't even want to start on Evolve, where their 6 ETF is essentially competing with their own bank ETF. Then there is Harvest. While they launch many funds, my backtesting shows that their legacy products like HDAE and HHLE suffered from performance lagging behind the underlying stocks in the past year. Therefore, in terms of management quality, I have a higher level of respect for Hamilton. I used to wonder if SMAX and QMAX were intentionally capping their upside to mirror the S&P 500. But looking back, that level of precision does prove the Hamilton team's excellent stock-picking ability. Think about it, you can't cap a return unless you're already beating the benchmark. If you aren't outperforming the index in the first place, there's simply nothing to cap. I have to admit, there are geniuses behind the scenes at Hamilton. Although I personally dislike the active management risks in a fund like HYLD, I have a lot of respect for the design of the DayMax series. To summarize my subjective view of Hamilton, they are a very greedy company because their management fees are high and they build closed-loop ecosystems to capture all the costs. However, they are also a highly competent company. They understand human nature, they know what investors want, and they have the professional skill to package it all together. This combination of greed and competence has allowed them to build a real moat in the market. I am Old Fish. If you enjoyed this content, please like, comment, and subscribe. I will see you in the next video.